Hi, everybody. I'm John Nersesian, and I'm so pleased to be joined by my friend and my colleague, Tony Crescenzi. Tony is a member of the PIMCO Investment Committee, and Tony is the author of The Strategic Bond Investor. So we all know, of course, that 2022 was a tough year for the bond market. Lots of volatility, saw a significant spike in rates. You've made the case recently, though, that this is an appropriate opportunity to think about allocation to fixed income. You want to expand on that a little bit?
Well, it's fairly simple in a sense. Despite the anxiety from last year, the repricing of yields has created attractive opportunities for investors because yields today look very attractive on three fronts. Number one, versus future inflation. Markets are priced for the inflation rate to drop somewhere into the low twos. This is based on inflation-protected securities and other gauges. So low twos, but yields today, according to the Bloomberg aggregate, which is sort of like the S&P 500 of bonds, that's in the low fours, and we think yields returns could be achieved around 5% plus when you mix that Bloomberg aggregate with investment-grade securities that we like. So yields above 5% relative to that 2% expected inflation is very attractive. Secondly, yields look very attractive relative to volatility. Of course, I'm not talking about 2022-like volatility, but historical volatility. Bonds tend to move perhaps around 5% per year. So thinking about a 5%-ish yield versus a 5% long-term volatility is a very good so-called Sharpe ratio. It's pretty good. And certainly very good relative to more volatile assets, such as equities, which tend to have volatility in the mid-teens and certainly a lot higher. And so on those fronts, it looks very good. And finally, when we think about yields, and we have to put them in the context of the diversifying characteristics of bonds, they tend to be a diversifier in times of stress. And that time of stress, who knows, could be around the corner if there's ever a recession. So we have to be thinking about that aspect, not just the yield in itself.
I love those references. So starting yields are a lot higher today, right? And of course, starting yields are a very key determinant in the total return that we might receive when we allocate money to fixed income. Well, let's talk a little bit more specifically about this active and passive decision that investors face. I know that in the equity markets, passive investing has really taken on a life of its own. What about in the fixed income market? What are the opportunities for active managers specifically to add value in the fixed income markets?
John, one of the first things that's coming to mind is something I read in a famous book from Frank Fabozzi, The Handbook of Fixed Income.
Oh, yeah.
There's a chapter in there written by our own Chris Dialynis, a member of the investment committee, on the importance of index consciousness. What does that mean? Well, you have to be thinking about the index that the investment you have is judged against and what's in it. So, for example, convexity. In the Bloomberg aggregate, it includes lots of mortgage securities. And that matters because there's more convexity in that than there is in a corporate bond index. Meaning, if yields decline, we know that homeowners would decide to perhaps sell their homes and buy other ones, or perhaps refinance their mortgages. The point is that the mortgages that are in the pool of the securities that investors hold will go away. And suddenly the duration, in other words, declines. And that's not what you want when yields are falling. So you got to be thinking about the convexity. You have to have some degree of index consciousness. One other point to make on index consciousness in this day and age, Uncle Sam has been issuing lots of bonds and making up an increasing part of these market-weighted indices. And that does an investor want to be investing more and more into U.S. Treasuries, which have lower yields than can be offered on other high-quality bonds where the chances of default we think are rather low, and certain ones that we buy, of course. No, and so investors should be thinking about what's in these indices when they're making decisions, and lots of decisions to be made today with these yields.
I love that point. I know that when I buy the index on the equity market, the S&P 500, I kind of know what I'm investing in and what kinds of attributes I'm going to receive. When it comes to the fixed income market, however, the ag, I'm curious how many investors actually understand what is in the ag and what they ultimately own from a decision to allocate to that.
And John, it's constantly changing too. And that's another point.
Yeah, absolutely. Constantly evolving. Look at all the new issuance in the fixed income market, which you don't necessarily have in the equity market, which makes that index replication, the replication of the return in the index, that high tracking error that we see, in the fixed income market, very different than what an investor might receive when they index to the
That's
equity
absolutely
market.
right. So it's not only a matter of looking at the yield on these things, but thinking about what's in the mutual funds, perhaps, that investors in. And more broadly speaking, John, investors today with the repricing of yields face an important decision point. And some of the decisions they have to make are personal and really up to the individual investor and advisors. There are three major parts of this decision point. Number one, how much volatility does the investor expect? PIMCO would suggest that volatility this year, 2023, will be a lot lower than last year. Secondly, an investor has to judge these yields against the amount of dry powder that they want. PIMCO itself is looking to have more dry powder. That could be in the form of cash or simply flexibility within a portfolio to maneuver from one asset to another. So, in other words, be thinking about liquidity. And finally, in this decision point for investors after the repricing of yields, investors have to think, how long do I want to continue to market time this diversification benefit that bonds tend to have? Because many investors are deciding, well, interest rates might rise more, so perhaps I'll take a break from bonds and simply buy them later. It's an idea we would suggest avoiding generally when seeking to diversify, especially if there's a recession around the corner, because bonds tend to have high excess returns, as they're called. They tend to fare well relative to equities and risky assets in those times of stress.
Yeah, I love that. And I love your reference to the individual investor and the challenges that they're facing. Tony, I have a suspicion that the decision-making process of the individual investor today is governed by the experiences that they had last year. It's recency bias. Wait a minute, I had a negative experience last year. Is that likely to replicate itself again this year? Loss aversion. I hate losing money. I saw a loss in my fixed income portfolio last year. Maybe that's something I'll avoid this year. These are the kinds of issues that many investors are facing, in addition to anchoring. I'm accustomed to a particular return or a particular data point. I kind of hold on to that and I make future decisions based on that. These are the kinds of challenges that the individual investor faces, which is why they're so often seeking the benefit of an active manager who can help them navigate the complexity of the fixed income market and the personal attention and guidance that they receive from a financial advisor. Tony, I want to thank you for the time today, and I want to encourage all of our viewers who have enjoyed this conversation to continue it, to continue to access the expertise that PIMCO can bring to the fixed income market by contacting your local PIMCO account manager. Thanks so much for your time today.